All right then. Good afternoon, everyone. As we are at the end of another week of trading on Friday, the 3rd of May. Relatively busy week across financial markets over the course of this week. We had the Fed. We've got just had NFP. Also had intervention from Japan, which we'll have a look at now in a minute. In terms of the rest of the economic data, you know, I'm not going to speak too much about the European side of things. I kind of got to focus on the US this week, but obviously GDP figures a little bit backwards looking anyway. But I'll have a look over the course of this week. I mean, I want to take a quick look though at some medium impact data that we had on where is it here on Tuesday, right? These employment cost figures, a bit of a negative start to the week. Monday, not too much going on Monday, but certainly into Tuesday, you got these employment costs, which is essentially what it says it is the cost of employing people in terms of wages, benefits, and then like a total index, right? These beat consensus across the board, right? A couple of them were upwardly revised upwards, and the cost of employing people rising. That is inflation. So that is wage inflation, which is something that the central bank have communicated to us in recent meetings that they are paying attention to. And wage inflation is a contributing factor to actual inflation. So inflation still remaining a bit high. We also had PCE or core PCE running at nearly 4% annualized over the course of the last year. We got the Q1 figures, we got these last week, but we got the Q1 figures last week, which then showed us higher levels of inflation, accelerating inflation over the course of Q1 in relation to Q1 last year. Still too high for the central bank to go and cut interest rates. We had a hot CPI print a couple of weeks ago, and inflation is still too high. Right? It's not just not coming down at the minute; it is also rising, which is obviously going in the wrong direction to what the central banks want. So then, coming into the Fed on Wednesday, the markets were looking for a hawkish Fed. Right? On face value of it, I mean, that's probably what we got was a hawkish Fed. Right? But less hawkish than what markets were kind of thinking, right? In the sense that markets were thinking that they could potentially talk about interest rate hikes. I personally thought they could talk about interest rate hikes. Historically, when inflation's running at 4% annualized in their preferred metric of monitoring it, 4% year over year inflation is traditionally hike interest rates territory, right? The fact that we're even talking about cuts in that in that scenario is a bit, it's a bit mental, to be fair. So they kind of had a job to do and to push back on interest rate cuts. I think they probably could have been a bit more prudent and suggested that there is a possibility for hikes. That's what other market participants thought, but they declined to confirm that. They said that interest rates, or Jerome Powell has said that interest rates have reached their peak, reiterated that interest rates have reached their peak or likely reach their peak for this cycle, and the next move will be a cut. He then declined to comment on when we would actually get that cut. If you remember back, sorry, if you remember back to last year, they suggested to us that we will get 3 interest rate cuts by year end. The market got way ahead of themselves and priced in 7, or started the price in 7. Then it went to 6. Then it went to 3. Now it's gone to kind of 2 or 1, depending on where you look. Kind of maybe 1.5. We'll go with now. When we actually get those cuts, we don't know, right? But the fact that they pushed back on interest rate hikes, said the next move was going to be a cut. Not sure when we will get that cut. The incoming economic data will then decide that. Right, we've had a little bit of weak economic data throughout the last couple of weeks. We had weak GDP figures out of the US last week. We had weak manufacturing figures on Wednesday. We had weak jobs figures on Wednesday. We've had weak non-farm payrolls then again today. So it's kind of reinforced the fact that you kind of got to work with what the central bank is telling you, right? The central bank is telling us that they are done with cuts, right, or they're done with hikes, should I say, and they're looking at cuts. And now every economic data print is either a step closer to interest rate cuts or a step further away from interest rate cuts. A few weak economic data prints were kind of looked at by markets then, and yeah, a bit of a dovish reaction to the Fed then was seen. We have a look with equities. Now, equities higher post Fed, that was the kind of up and then down again. But once the markets had a bit of time to kind of gather their composure a bit, they have then trended higher. You also had Apple come in yesterday with strong with strong earnings, launching the biggest share buyback scheme in stock market history. Apple shares then rallied off the back of that 6% last time I checked. Obviously got cash open in a couple of minutes, so we'll see where they open up now in a bit. But S&P, you can see S&P pushing higher post Fed, the Dow Jones, the Nasdaq, the Russell, all of these higher. They are also now aggressively higher post NFP. Weak jobs market, it kind of is a bit counterproductive in terms of equity market strength when you look at it. When you dumb it down a bit, when you actually think about it, weak labor market brings forward the prospect of interest rate cuts. I mean, they're not going to cut interest rates off the back of it. That's not what I'm saying. But any weak economic data probably likely to be looked at positively by stock markets. That's the way it works until it gets so bad we're looking at a recession, but we're nowhere near that just yet. So weak economic data does give stock markets a bit of a boost. We then look at the US dollar, and the same thing across the US dollar. We see the Aussie, the Kiwi, the Euro, the Sterling all set to end the week higher. Dollar Swiss, dollar CAD to end the week lower, and dollar yen is a bit of a different one, but we'll get back to dollar yen in a bit. We kind of got some higher time frame technical levels that have now been broken. This trend line and the resistance level here that I've had on my charts on the Aussie has now been broken. Euro dollar is through this resistance level, now eyeing this trend line up at 108. Look at Kiwi through a resistance level. Cable also through a trend line. You look at dollar Swiss testing a trend line to the downside. That goes in line with some strong economic data from Switzerland yesterday. We had slightly higher than anticipated CPI. Not that changes anything from the S&B's perspective, but does help give dollar Swiss a bit of a kick lower. Dollar CAD lower, now testing this trend line. It'll be interesting to see if that breaks it. But dollar yen back at the prior intervention level of technically 151.944, but 152 we'll go with. But you can see, people saying suspected intervention because I haven't come out and actually confirmed it, but I think it's pretty clear. A currency pair does not move 500 pips lower in an hour without something going on, right? So dollar yen down massively. Crazy day last Friday, and dollar yen just went through the roof, and it was sold back into when we got 160 or hit to 160. Now they said that the idea is that it took them 40 billion US dollars to go and do that, right? They said a report said they basically have 8 bullets in the chamber, right? With that 40 billion being one, the Nikkei, the news source out in Japan, said that they've got 8 bullets left in the chamber. One bullet was 40 billion US dollars. That would mean they have 7 left. Post Fed, on a slightly dovish reaction to the Fed, they jumped in and then they sold more. That would be a second bullet. That would leave 6. I mean, from their point of view, it probably would be a sensible thing to try and jump on these weak jobs numbers and go and bury dollar yen, but I'm not sure they can really go and do that. But it would be pretty smart if they didn't have to think about the consequences from anyone else. But certainly when a country gets involved in the financial markets, essentially just taking a position like we would. I mean, obviously not the same as we would. It's obviously a massive amount more money, but it's essentially doing the same thing, and just selling dollar yen. That has made dollar yen end the week, or looking like it's going to end the week 800 pips lower. It's a massive downside. Would have been doing pretty well for yourself if you got short up at 160, wouldn't it? But yeah, that's kind of what we're looking at today. A hawkish weak jobs markets causing, we'll call it a dovish reaction in the market, but stocks higher, the US dollar lower. Look at yields getting whacked off the back of that, which is understandable. Gold a little bit all over the place. Gold kind of looking like it wants to sell off a bit now, but kind of gold kind of a mind of its own this week. And Bitcoin enjoying that as well. Bitcoin rallying up through 60k again, up past 61 now, enjoying the weak jobs figures from the US. But the Fed pushing back on interest rate hikes, confirming the next move is going to be a cut. When that cut happens, we just don't know, right? Economic data, then you look towards the economic data, and you got to kind of hope for weak economic data to come in, right? US dollars are heavily net long. If you look at the CFTC positioning, pretty overstretched longs. That would cause a bit of a position unwind if the US dollar was to come back. So if the US dollar does decide to continue to strengthen, should be a relatively good move to try and take advantage of. But we'll see how that goes throughout the rest of the day. We got these services PMIs at 3 o'clock. Hopefully that gives us a bit of a boost to dollar downside and then stocks upside. So we'll cross that bridge when it comes to it. Best of luck if you try and trade the services PMI, being a pretty good week of trading. What that means going forward, let's see how the services PMI comes out, how markets run into the close today. But you'd probably have to imagine short US dollars, long stocks into next week. But when we get there, we will go through that in as much detail as we can. But yeah, that kind of brings us to the end of this video. It's a bank holiday in the UK on Monday, so the week ahead video will be on Tuesday next week. We'll cross next week when it comes to it. But enjoy a long weekend, switch off, recharge the batteries, and we'll be back again, as always, next week for another week of trading. Thank you.